Okay, so let's go ahead and get started. I want to welcome everybody to the Copperwind Financial third quarter webcast for 2021. Today is Tuesday, August 24th. The last time we had one of these was way back Cinco de Mayo. It's amazing how time flies. I actually saw today, I believe, and Linda can confirm this, Starbucks is already has pumpkin spice available. I saw Halloween stuff in the stores the other day, way too early for Arizona. As it's supposed to be 108 today, tomorrow, Thursday. So pumpkin spice is not on my agenda yet, but it's amazing that it's already the end of August. So I'm Eric. I'm glad to have David, Linda, and Jake with me again today. I want to thank everybody for coming. It's great to see everybody's names who's logging in. Looks like we've got a pretty good crowd again today. So thank you for joining. A couple of housekeeping items. So everyone's muted. We've got about 30 minutes of prepared remarks, and then we'll take Q&A up to the top of the hour. So on your Zoom window, you can ask questions throughout the presentation. Definitely encourage it. There's a little Q&A feature at the bottom. We are recording this webcast, so it'll be posted to our website in the next couple of days. So please feel free to forward this to anyone that might benefit from it. And we're also going to make the slides available today. So if you want them, please let us know, shoot us an email through the Q&A, let us know, and we'll get them out to once we're done with the presentation. So with that, I want to go through a short overview of what we're going to touch on today. So we're going to have a year-to-date recap, just touch on a few data points that brings us up to the end of July. Do an economic update and talk about current concerns, economy, market, investment-wise, roll into the investment issues that we see going forward now to the end of the year, and then finish up with some financial planning tips that we've been working on with a lot of you. So with that, let's start with a few data points. Like I said, these numbers are through the end of July. So on the stock side of things, we're seeing things that we've seen for almost the last 10 years. US large cap is the place to be. It's definitely outperforming emerging markets. Developed international, US large cap is up 18% as of the end of July. And actually right now, I think yesterday, the S&P and the NASDAQ hit all-time highs. And so those numbers are only bigger as we go. On the bond side of the equation, though, bonds have struggled this year across the board. Continued low interest rates have made it hard. As you can see, really, regardless of what kind of fixed income category you're in. Now, we'll touch on our bond side of our bond approach of our portfolio a little bit later in the webcast. We are net positive for the year. So the next slide with the two graphs explains a little bit about why we've seen such a strong bull market this year. While interest rates started to rise earlier this year, they never really reached escape velocity. And they've come back down. This in turn has supported the returns so far this year in the stock market. Let's be clear though, it has been a bumpy ride. It's not as smooth as the green arrow on the right from going from left to right leads you to believe. And given the recent discussions around interest rates, we expect it to continue to be a bumpy ride going into the end of the year. But we have been saying for some time is, markets at an all-time high, better be careful. Again, today, markets at an all-time high, but we'll talk a little bit more about that later on how long that may last. So with that, I'm going to turn it over to David. He's going to catch us up on some economic data that has contributed to some of this bumpy ride. So David.
Thank you, Eric. Eric twisted my arm to get me to talk about economics because I know all of you that know me and have been in meetings with me know that I don't talk about economics very much, but I will try. So let's go and start looking at the GDP numbers initially. On the left-hand side in the box there, what we see is the huge bumpy ride, as Eric talked about, not on the market, but on the GDP numbers of last year, where when everything got shut down in Q2, it dropped 30. And then when it opened up, it jumped up 30%. But since then, nearly every quarter, we've seen a steady increase in GDP. Now, you may look and say, yeah, but David, in Q2, it looks like the forecast was 8.5 and it came in at 6.5. That was a big miss. Well, it was a miss, but most economists are not that concerned about it because about 1.5% of that was in drawdown in inventory. And the way GDP is measured, it is the total amount of goods and services that were produced in a quarter or a year. So if I have a store and I'm buying things either from the factory or I can use them out of my inventory, if I sell 5 widgets and I use them out of my inventory and I don't order them from the factory, GDP doesn't go up because the factory didn't make new ones. But why we're not concerned about it is because in the following quarters, I'm going to replace that inventory. So really, it's more of a timing issue. So when we look at that, we look and we say, are we concerned a little bit, but not a huge amount. If you look on the right-hand side, the box there, we look at last year's GDP of minus 3.5, which was terrible. But when we look at this year's estimates, I mean, they're at 6.6%. We haven't seen that kind of GDP growth since probably the early 80s. And even for next year, 3.8, that's the best numbers for probably 20 years. And then in 2023 and going forward, we're going to be back to where we were pre-pandemic, 1.5 to 2.5% growth, steady growth. And the markets did quite well, and the economy did quite well during the decade that we had that. I will tell you, given the Delta variant and some of the concerns that people have there, what you're starting to see is some economists that are saying, well, that 6.6 may be less. You're starting to see a little bit of dip in some of the travel, some of the airlines, hotels, and even on the restaurant side. So still, even if it comes in at 6%, it will be a very good number. So GDP continues to do well. Let's talk a little bit about the employment side. And what we're seeing is very robust employment numbers. Now, these numbers right now, we're looking at a chart that goes back to the start of the pandemic and how many jobs were lost and how that's recovered from then. So at the worst, when it first shut down, I mean, we lost 22.5 million jobs. And we've had a steady recovery since then. We're at a 5.4% unemployment rate, and that's still a little bit elevated, but probably by the end of next year, we'll be down at the 3.5 to 4%, which is full employment. Now, you may look and say, yeah, but I'm seeing a minus 5.7 million people that don't have a job right now. Some of those will never come back. And part of that is companies that have become more efficient and figured out how to do it with fewer people. But a lot of it has to do with additional people that are retiring early. Some of them are retiring early just saying, hey, I reevaluated what my goals and objectives and values are, and I'm going to retire early. Others that thought it would take 3 to 5 more years for their 401k and IRA to get to levels that they felt comfortable retiring on, they've seen that in the last 18 months. So most of that is pretty good. I'm not so worried about the employment. In fact, if you look, we have more jobs out there than we're actually have people unemployed, and that's a rare event. The other side, if you look at the real estate side, is it in a bubble? It's gone up dramatically. Any of you guys that have tried to buy a house or sell a house, I mean, it's crazy out there. The median list price across the U.S. in the last 12 months is up 13%. But if you're in Coeur d'Alene, Idaho, or Billings, Montana, or Austin, Texas, you're up 40%. I mean, crazy numbers. Days on the market has been cut in half. Active listings down 40 some odd percent. I will tell you, you are starting to see some increase in supply, and part of that's coming from the moratorium on foreclosures, moratorium on evictions. All of those things, even the forbearance numbers. There's about 1.7 million people that have mortgages that are in forbearance, meaning that they're not paying their full mortgage. So I think you will have more active listings going forward. The supply will go up, and is it a bubble that's going to drop dramatically? Probably not. Could it come down some? Absolutely. Anytime you have a big market up like that, it could come down. But the difference between now and the Great Recession was back then, all the financial institutions, banks, credit unions, savings loans, all, insurance companies, all of those were in terrible shape. Right now, they're in the best shape they've ever been from a capital perspective. So we're concerned about that, but it's not one where we look and say, oh, we've seen this before and everything is going to drop 40%. So we're talking about, oh, things look really good. But the reality is, if you look, that we do have some reasons to pause here and we look and we say there could be turbulence up ahead. And for those of you in Arizona, you've seen a lot of those thunderheads over the last 6 weeks. Thank goodness, because we've had a lot of rain. But everything is fine on the plane right now. But Linda's going to go through some of the issues that we're concerned about, because to look and say, oh yeah, it's great, it's just going to get better all the time and we're not going to have any big problems. I think that's not the way to look at it. So Linda, why don't you tell us the concerns?
Sure. Yeah, the clouds have definitely been welcome here, but maybe not so much if we see them impacting the stock market. And we did comment in our market commentary this month about the fact that we are starting to see a little bit more turbulence in these markets. And the things that we specifically are concerned about include inflation, and whether that is transitory or whether it is persistent, COVID and the arrival of the Delta variant with its potential to upset the recovery, and then debt, which is a 4-letter word when it comes to economic health. So let's start at the top with inflation. So one of the key metrics that economists watch is the CPI, or Consumer Price Index. And this tells us how much we as consumers have to spend on basic living expenses. And as you can see on the far right hand side here, at 5.4%, the last 4 months have certainly exceeded anything we've seen in price increases over the past year. And in fact, at this run rate, it's going to be the fastest annual increase in over 13 years. So let's look at a few of those things that caught our attention and whether what we're seeing, as Chairman Powell of the Federal Reserve has stated, are they transitory or are they persistent? Last quarter, we talked about how much lumber prices had spiked from $400 per 1,000 board feet pre-pandemic to over $1,600 just a quarter ago. And then if you remember at the beginning of this month, our commentary, we talked about that price had dropped to $620. Well, guess what? In 3 short weeks, we're now back to pre-pandemic levels. So dropped even further and rapidly. Absolutely, when it comes to certain supply issues, we've seen some transitory nature to pricing then when supply catches up with demand. Now, that being said, while raw material costs like this have dropped, what do you want to bet that the price you're paying for lumber at Home Depot hasn't seen that same rapid decline? In fact, I think here at the office, I'm pretty sure we're still paying a fuel surcharge for our UPS packages. They added that on back when oil prices spiked to $140 a barrel, and that was in 2015. So definitely when we see pricing increases that rapid, they can persist, not necessarily at those levels, but certainly higher prices can persist if we as consumers have demonstrated we're willing to keep paying some of that premium. Speaking of premiums, so car prices, both new and used have seen price spikes driven in part by the chip shortage we have right now. The Car Guru index that you're seeing here says we have seen a 13% increase in just the past quarter and a whopping 31% increase versus a year ago. So how crazy and unusual is this? Well, I know somebody who bought a Lexus SUV back in March, then decided he'd rather own a Tesla, so sold his Lexus this month for more than he paid for it new, not even 6 months ago. But look, chip shortage goes away. We probably won't see that happening a year from now, right? I mean, supply catches up to demand and we see prices calm down. So again, transitory. But let's look at a few things that maybe aren't. Earlier, David talked about real estate and the escalation in home prices, but how that's now started to show some signs of stabilizing. One reason is understandable reluctance for buyers to play the game and pay a premium necessary to get into a home. I mean, we saw crazy things, waiving appraisals, waiving inspections, buying sight unseen, incredible lines to get into homes. I will tell you anecdotally, a lot of that has calmed down dramatically. So people are waiting, but instead of buying, they're renting. And according to this graph here, we've seen rents jump 7 to 9% on average across the country, with our hometown here, Phoenix, taking the award for the highest year-over-year increase at 25%. Now, is that transitory? Well, unless we have a massive increase in the number of homes available or a drop in disposable income and people's ability to pay, I think we're probably going to see this persist for much longer, certainly than the lumber prices that spiked. Now, what about income? Well, David talked a little bit about this earlier. You see them everywhere, help wanted signs. And we currently have more job openings than we have people unemployed. We lamented following the financial crisis from 2008 that workers took the brunt of that recession and wage growth did not keep up with the recovery in the economy. Well, it looks like we're making up for some lost time and then some. We haven't seen such a robust jobs market since the end of World War II. And employers are having to get creative. They're offering signing bonuses, they're paying for education. Shoot, in some cases, they're even paying people just to come in and fill out an application. The problem is that wages play a unique role in the inflation equation and can trigger what's called a feedback loop. As wages rise, we then see prices increase for products and services to cover the higher labor costs, leading to higher cost of living, then leading to additional pay increases and so on. Now, for example, if I bump David's salary $25,000 this year, and next year the number of jobs and the unemployment people looking for jobs falls back into a normal range, how likely is it I'm going to be able to take that $25,000 back from David? Probably not very likely. So the inflation, wages tend not to be transitory. And the inflation conversation is just getting started, believe me. So COVID, I don't know about you, but I'm completely done with living with, talking about, planning for, surviving this darn pandemic. It's so fatiguing, and that's probably a gross understatement. But having mutated now into the Delta strain, we've begun to see another spike in hospitalizations. And the impact that's having is not just here, but China recently shut down one of its shipping ports in response to an increase in their positivity rate. And as we know from the earlier conversation on supply chain disruptions, that absolutely can have an impact on our economy here. So this virus and its many future mutations isn't going away, and we're going to have to learn how to manage it or suffer the disruptions and potential harm to our economy. And then money, money, money. I don't know why I suddenly feel like I have to break out into singing that Pink Floyd song, right? Maybe not. Well, whether it's the Federal Reserve continuing to buy bonds, now up over $8 trillion on their balance sheet and climbing, or the government stimulus program spending, the printing presses seem to be running nonstop. We're now at national debt levels that rival anything we saw following World War II. Inflation and COVID and printing of money, while these are all concerns and they are going to impact investment decisions moving forward, they might not all be bad. But David, why don't you take us through how we're seeing these things affecting investments through the rest of the year and maybe into 2022?
Okay. Cool. Thank you, Linda. So I'm going to talk a little bit about why we're fully invested despite the high valuations that we have, why we don't fight the Fed or the federal government. And the most important is, when does the tapering of the bond purchases and the printing of money by the Fed, when does that begin and what does it look like? So let's start on the valuation side and why we're fully invested. So if you look, this is a chart over the last year. The blue line is the S&P 500, showing continually all-time highs, up, 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 with some pullbacks that have been fairly substantial a couple of times. If you look at the black line, that's the earnings per share, and it also is continuing up, up, up. Those numbers have been very, very good this year. Most of the time, the earnings estimates have underestimated what companies actually produced, and that has been what has really pushed the market a lot higher. Now, if you look at one of the metrics that a lot of people use, which is the price to earnings ratio. And that's, let me give you a quick primer on that. We use a lot of jargon in our business, and a price to earnings ratio is just the price of the stock or the index divided by the earnings. And so one of the ways I like to look at it is it's how many years of earnings does it take to get back your money from the price you pay. So historically, that number has been about 15 or 16. So if a stock was trading at $15 a share, it would have $1 worth of earnings, and it would take 15 years worth of earnings to equal the price. Right now, that number is 27.3 based on Q2 numbers. If you look over the last decade, it's been elevated. It's been at 21.7. Now, how does that come down? If you look, you can have the price go up, the price come down, or earnings go up. Well, both of those have been going up. But if you look and you say, well, David, what happens if earnings continue to go up and the price stays where it's at? Well, by the end of the year, you'll be down at 23, 24 PE, and in the first quarter, you'll be down at 21 PE. Now, that's still an elevated level. And when you look at the current levels, and people say, well, yeah, but David, it looks like a bubble. I mean, 27, when was it higher? Well, it was higher back in the dot-com bubble days. And one of the famous statements that Alan Greenspan, who was the long-serving Fed chair, made was that there was irrational exuberance in the NASDAQ by investors. And people say it was clear he knew there was a bubble, and that is exactly correct. But if you look when he said that, that was in December of 1996. And so if you got out of the NASDAQ in December of 1996, the next year you did not participate in the 20% increase that the NASDAQ had. And in 98, the year after that, the 85% increase in the NASDAQ, or the year after that of 101%. So yes, you could have been correct that there was a bubble, but you missed 3 of the best years the NASDAQ ever had. So we're not looking and saying, oh, it's really expensive, so we're going to move out. Our models have told us that right now the trend is still higher. And as long as that is the case, we will be invested. Our models at times, pulled us out, and they did that last year in end of February, early March, that saved a lot of downside. But we're not forecasting and saying, oh, we know it's going to go down, so we're getting out. We use the models. If we look at why everything's still going up, there's a couple of things. The Federal Reserve, as Linda talked about, they're printing $120 billion a month and buying bonds, and they're pushing that into the financial system. The federal government is printing trillions of dollars, and they are borrowing the money and sending it out to individuals on Wall Street, where most of the Federal Reserve money is going to the institutional market. It's going to, not to Wall Street at the federal government level, it's going to Main Street. And so you're raining money into the economy. That tends to push risk assets, real estate, stocks, and bonds higher. So we're not going to fight the Fed in this, but the most important thing really is going to be, when does the Fed start to taper? And what does that look like? And tapering means when they start to reduce the amount of money they're printing and the amount of bonds that they're buying. And that will start probably in the next 3 months, where they will start to reduce it. Right now it's 120 billion a month. They'll probably reduce it to 100 or 80 and 60. And over a 6 to 18 month time frame, they'll stop purchasing all the bonds. At that juncture, then they will say, do we need to raise short-term rates? If inflation is still up where Linda was showing it, of significantly above 2%, they probably will raise short-term rates. But that's probably 18 to 24 months from now, unless inflation gets completely out of control. So that's the most important driver right now of the stock market, is Federal Reserve policy. And it's not just the Federal Reserve, it's central banks are all around the world. I mean, one of the questions that I've come up a lot of times, if we're printing all this money, isn't the dollar going to go down? It would, except all the other currencies around the world are doing the same thing. It's sort of a rush to how many trillions of currency dollars you can print. But all of the stuff that we've been talking about here, we're saying, well, that's sort of the trend, the forecast. We think theoretically this will occur. What I'd like to do is turn over some time for Jake to talk about some tax saving financial tips that are not based on, oh, we think we might. You can actually save some real dollars by doing some good financial planning. Jake, take it over.
Yeah, thanks, David. It's funny. It feels like we are not too far off from having year-end planning meetings. I mean, time sure flies by pretty quick, but one of the topics that we love to discuss with our clients is just ways to save taxes. And so today in my financial planning tip, I just want to highlight 3 ways that you can save taxes while doing your gifting for this year. Many of you have been aware of these, and this might be new to some, but donating appreciated security. So we'll talk a little bit more in detail about that. Charitable lumping, which is probably my favorite. Qualified charitable distributions. And we realize that this may not apply to everybody, but those that are charitably inclined, these tips are going to be worth their weight in gold. So let's talk through it. We'll start with donating appreciated securities. We run across a lot of individuals that still donate cash to a charity. And that's one of the least efficient ways to do a donation. In fact, it drives us kind of crazy sometimes. We're like, you have appreciated stock, let's use that. But there are times where cash may make sense to donate rather than a stock, but generally it's the least efficient way. And as David kind of mentioned, over the past really year, frankly, over the past 10 years, the market has been very strong. And there's been a lot of gains, both on the stock market indices as well as certain securities. So now is a great time to kind of consider this strategy if you haven't done so before. But here's how it works. So let's say, for instance, you buy a stock, we'll call it XYZ. You paid $5,000 for it. Today, now it's worth $50,000. You hit a home run. And let's say that you're feeling rather generous and you just want to give that full $50,000 to a public charity. So you have a couple of options. On the left-hand side, option one, you could sell the stock. You'll end up paying the taxes on the capital gains. And then you can take the remaining cash and donate it to the charity, and you'll get a deduction for the amount that you donated. Second option on the right, you could donate the stock. The entire value goes to the charity. You avoid those capital gain taxes, and you still get a deduction for the donation. So you can see in this example, not only does the charity get more money, but the tax savings a lot greater by donating the stock. The other thing to kind of keep in mind is that you got to be aware of is the donation that you make has to go to a qualified charity. So some type of nonprofit organization such as a 501c3. It can't go to like a child or a family member. The other thing is, in order to get the deduction to be the full market value of what you donated, you would have had to held the security for more than 1 year. So that's important. And then there are some limitations on how much you can deduct depending on the type of charity you give to, as well as your income for that year. So those are some of the things that we would love to talk to you about, certainly coordinate with your CPA on. But donating appreciated securities, it works really well. It works well for somebody that wants to unwind a concentrated stock position that they have. It also works really well just for those regular donations that you give to a church or your favorite charity every year. The other thing that kind of comes into play here is donor advised funds. So sometimes individuals might say, well, I want to give a donation, but I don't know to which charity, and I'm not really sure how much I want to give in that particular year. Well, a donor advised fund comes in handy in this way. So you can donate either cash or a stock to this fund. You then get a deduction for that. But the advantage here is that that stock or that cash doesn't go to a charity immediately. In fact, it's still in your control. You can choose to invest that money and keep it growing. And then in the future, you can then decide, okay, here's who I want to give it to. And you can do it over time to multiple charities. And so it's a great avenue that you can leverage, especially if you're in, let's just say you're in a high income year for one reason or another, like you sold a business, or you got some stock options, or you got some large bonus. This works really well because you could do a substantial amount of gifting in 1 year, lower your tax burden, and then over time, over multiple years, donate to the charity of your choice. Okay. So the second one that I wanted to touch on is this charitable lumping. This is, like I said, this is my favorite. And the reason why is over the past several years, there's been a lot of tax changes, and more people are taking the standard deduction rather than itemizing. And so sometimes you might make a charitable donation, but because you're not even itemizing, it doesn't even help you from a tax standpoint. So this strategy helps you leverage lumping multiple years of your donations into 1 year, and then being able to take the standard deduction in the years that you don't donate. And this on your screen, you'll see this is us lumping 4 years together, and then your because of those lumping of donations, you're now able to itemize and you'll effectively save more in taxes. In fact, what we generally will see is that most people will do it every other year. They'll lump donations together in one year, and then the next year take the standard deduction and keep doing that. But we found that this has saved people hundreds, if not thousands of dollars every year in taking advantage of this. And so that's one of the things we really love to talk about at the end of the year. The last one is doing what's called a qualified charitable donation. And I don't know if you're aware, but you can donate IRA money to a charity. Now, it only works in certain instances. You got to be a little older. You got to be age 70 and a half, but you're allowed to do what's called this qualified charitable distribution, where you take a distribution from your IRA and send that money directly to a charity. You know, normally when you take money from an IRA, it counts as ordinary income and you get taxed on it. In this case, you don't get any taxes because it goes to the charity. So it doesn't give you a deduction like a normal contribution to a charity would work, but you don't have income. You don't have that additional income that you would normally have. So the reason why this works sometimes is because it allows you to keep your taxable income maybe lower, and sometimes that can help avoid some of the additional taxes you might find on Social Security and other things. The other thing that this works really well for is if you don't have any appreciated securities in a non-retirement account. And then also if you're doing your minimum distributions after the age of 72, this works really well to satisfy that as well. So now all of these tips and techniques that we talked about have a lot of complexities. I've just hit it in a high level. So these are the things that we'd love to talk with you about at the end of the year. You know, in fact, none of these things is kind of a one size fits all. So we want to have the discussions. We want to work and coordinate with your CPA on these and help you guys save taxes. So that's why we bring it up. We'll be having these meetings over the next 3 or 4 months. And we'd love for you guys to reach out to us and schedule something if you'd like to talk about this in a little bit more detail. And with that being said, this concludes our prepared remarks. So we'll want to move into the Q&A portion of the presentation.
Yeah, so we've gotten a couple of questions. Let me try to lump them together, and I'll tee this up for really anybody that wants to jump in. So Congress is considering spending more money. So we talked about, Linda made the comment about debt, a lot of the infrastructure that's going. And the question comes up, how are we going to pay for this? So a lot of conversation about raising taxes on the rich, raising taxes. So just kind of curious about, one, could these tax changes become retro to the beginning of the year? And how likely do we think that something's going to actually happen in 2021?
Well, I could jump in there on a little bit of this. Could it be retroactive? By law, it could be. Has it historically ever been retroactive? Not normally, especially if it's in the latter half of the year and we're going, for something to get passed, it's going to be in the next couple of months. Nothing's going to get passed next year on taxes because nobody's going to want to vote for tax increase during an election year. So the closer you get to the end of the year, the less likely that there's any significant changes. We've already seen it. Initially, it was, we're going to raise it to 39.6 on $1 million incomes on capital gains. Now, what they're talking about is 28%. They were talking about 28%. Raising taxes on corporations to 28%. Now they're talking about 25%. So will there be some tax increases? Probably. Will they be will they be as dramatic as the campaign talked about and earlier in the year they talked about? Probably not. And I think there's a very low likelihood they're retroactive. They may be what they have done in the past, and there's quite a bit of precedent for this, is that they can become effective when they are introduced, the bill is introduced in Congress, so that somebody doesn't run out, it looks like it's going to get passed, let me sell this or do some other financial transaction to get ahead of it. But going back where they've talked about starting back in April, probably not going to happen. But we'll have to see. I mean, there's a lot of moving parts there, and there's a lot of spending. And right now, most of that spending is just being absorbed by the Federal Reserve buying up the bonds.
So another question, a couple of different questions, really surrounding Social Security. So do we see any changes coming to Social Security, talking about either trying to fix it, which we've talked about for a long time, and or is there a way to pay for some of these things? And so I know there's been some discussion about the cost of living adjustment. So there's already some levels out there that they're expecting the highest. And David, you remember this because you're the oldest out of all of us. I think the highest level of increase in Social Security since 1981 or 1982.
Yeah, the late 70s and early 80s was when we had double-digit inflation. So, I mean, we the last few years it's been nearly nothing to maybe 1.5%. And it's going to be dramatic. I mean, it's probably going to be 5-6%.
Yeah, there's the last article I read. So we were 1.2% was the last raise, and now they're talking 6.1, 6.2 for next year.
Yeah.
Back to Linda's comment about what's transitory. That's not going to be transitory. You're going to have a cost of living increase that's going to stay. I think the other side of the question is, do we see changes coming to Social Security, which means is more of it going to be taxable? They've tried to close some of the loopholes. So I haven't read anything or had any discussions recently about changes to Social Security on whether or not you feel like we need to fix it. I don't know if anybody else has any comments on that.
Yeah, I can make some
David's
comments.
always said when we have this topic come up that fixing Social Security is easy, right? You actually.
We having some technical difficulties here.
It's not Social Security. And right now it's Medicaid. And if interest rates start going up, we'll soon see that it's the debt service on a national debt. So I think there's a couple things to worry about a little bit more than Social Security right now. Wouldn't you agree, David?
Yeah, absolutely. I mean, they will fix it. If you look right now, I think 2034 is when they look and say we're out of the trust fund monies, and so we don't have enough to pay for it. And they're talking about numbers anywhere from 75 to 87%. They're not going to allow that to occur. They're going to increase the cap on where the taxes are being paid. They will probably rejigger the cost of living adjustments. Every time they do that, it's not to make it more fair. It's always to reduce what that number is because they long term. I will tell you, it's interesting. I turned 62 last year, and I got a letter from Social Security just in the last month saying you're now eligible for Social Security at 62 and a half. But what it said is the best way to look is to apply for it, and then you can see how much you're going to get. There was nothing on there saying, oh, if you take it now, you're going to get dramatically less than if you wait till your full retirement age, or you should wait until you're 70. And I'm wondering if that's one of their strategies of get people to take it early, because ultimately you pay out a lot less money. So they're going to fix it. And it's going to be both in more taxes and probably reduced benefits. And it would not surprise me at all in the next couple of years that they will pass a law like they did 20 some odd years ago that will go into effect, and it will affect people that are 25 or 30 years old and younger. And it will say you can't retire at 67, it's 68 or 69 or 70. Because those people at this juncture, they think, I'm never going to get Social Security, so I don't care. And so they don't vote about it. But if you tell somebody that's 55 or 60, we're going to make you work a few years, then those people, and AARP comes in, those are the people that can change elections. So they're not going to touch that. They will set it up for those that are 25 and 30. Yeah, it's a long way. Don't worry about this, but that's the way they're going to fix it.
A couple other questions when we're talking about the Fed raising rates, how that's going to happen from a taper and then ending and raising rates. I think the question that we're all wondering is, how high do we think they're going to raise rates, right? You go back to 2006, Fed funds was what, 5.25. Do we feel like we see them raising rates to those levels again, or is it more pre-pandemic where we kind of started to raise it? We got to what, 2.5, and then it just comes right.
Yep.
Wait long enough, there's going to be another issue that comes up that causes the Fed to cut rates. And so I think it's more how high do we think there's going to raise rates, because we've been penalizing the savers. You don't get paid for anything.
Well, I will tell you, I've seen a couple of economic studies in the last 60 days that indicate that forecast that by the end of 2022, mortgage rates will be at about 3.7%, up from 2.25, 2.5 right now. And that's, just them looking at, if you took out, because right now we're at, I said 120 billion a month is being purchased in bonds. 40 billion of that is mortgage-backed securities and 80 billion is treasuries. So if you stop buying the 40 billion worth of mortgage-backed securities, you've got to bet that mortgage rates are going to go up some. I mean, it's crazy right now, to my way of thinking, when you look and you hear Fed governors and Fed bank presidents, the regional bank presidents, talking about being concerned about real estate prices going up so much. Well, they're the reason. They're a significant part of the reason it's going up. I mean, they're digging the hole there, and they should have stopped long ago of buying mortgage-backed securities. But they'll blame somebody later on. But it will go up. Will it go up to 5? Probably not. I mean, I think it goes back to the 2.5 to 3, and that may be 3 years from now. But you will probably see in the September meeting discussion and maybe even announcements that they're going to start tapering by the end of the year. If it's not then, the next Fed meeting is the first week of November, and I'm sure they'll announce it then. But they should have started tapering already. But I think they look back at 2013 when Bernanke started the taper tantrum, and the markets reacted, violently to that, and they're trying to, wait. But I think they're ultimately going to be wrong on inflation. There's going to be more that's permanent. Some of it's not going to be transitory, and they're going to get themselves behind the 8 ball.
So talk a little bit, maybe everybody can chime in, because we have our big investment meeting on Monday mornings. And some of the questions that are coming through, which we've seen not only today, but in our previous webcasts, and we have this discussion with clients one-on-one, is, how do we see our portfolio changing going forward? What kind of asset allocation differences will we see, from the past 10 years? And I know Jake and Linda and David and I debate that every Monday on what that looks like. So, a lot of what we do is models based. So I don't know, Jake, you want to take a stab at some of the things that we've discussed, or Linda, your thoughts. But I would say David's pat answer would be it's going to be models driven. So
yeah,
Jake?
Yeah, it's interesting. I mean, we've had various discussions. The typical type of investment strategy tends to diversify you into all sorts of asset classes, whether it's international, emerging markets, small cap, mid cap. And we've continued to follow the trends. And, this year, earlier in the year, it seemed like value was picking up. Even some international was doing better. Small cap was doing better. Those trends have completely reversed. And so one of the things that you've seen our portfolios do is it's continued to shift more and more to, large cap US, because that's been the place to be. And that's been one of the things that's really helped us over the past 10 years is focusing on those trends. At some point in time, those trends will change again, and we'll be able to see some of these international markets do a little bit better. But that's been the biggest, I would say, sticking point over the past, 5 to 10 years, is just how much the U.S. has outperformed other asset classes.
David or Linda, any other thoughts? I think Jake summarized our Monday meeting pretty well in 2 minutes. It's definitely a much longer conversation than that, but
yeah, without all of the arguing and pulling of hair at the same time.
Exactly.
Okay, well, maybe some of us still have hair, but
I obviously have the biggest issue. So
yeah. Now, I would just add to that if we continue to see persistent inflation, the thing that will probably happen is a devaluation of the dollar. The dollar would decline. If the dollar declines, then we see things like international that Jake alluded to earlier, which has suffered in the second half of this year. International might do better. Commodities might do better. Those are two things that with the strengthening of the dollar here in the last 6 months have completely reversed their position. But David's going to chime in and say, but we're not going to make those trades until the models tell us that that trend has established itself.
Well, no, I would never say that, Linda. I can't believe you'd think I'd say that. But I will go back to what Warren Buffett said in May in the Berkshire Hathaway meeting. He was talking about that there are a lot of the large US corporations, especially on the technology services side, that have the ability to create enormous cash flow increases with very little additional capital. And that is, I think, what is driving. When you look at Amazon, when you look at Facebook, even Microsoft, Google, a lot of those that they just have an enormous amount of cash flow. Where if you go back to the traditional, the GMs, the GEs, the Walmarts, if they're going to grow, they have to put a huge amount of new capital in. And those that can leverage that up and generate cash without additional using a lot of that cash in new capital that they have to put in is going to be the winners. And that's what we're seeing right now and have for the last decade. And it appears to continue.
The other big question we have, and it's a conundrum, and so I appreciate the question today. But we've been asking ourselves this forever. I joined Copperwind back at the beginning of 2011, right? So you think about the discussions that we had after 2008, when we thought at the time the Fed was printing and the government was spending a lot of money, and we thought, wow, how is this not going to end badly? And going back to the graphs that we showed earlier, what we're doing today dwarfs what we were doing back then. And the question still is, how does all this not end badly, right? Dave and I had that conversation. When you go back to your MBA studies, your classic finance, econ studies, if you would have told anybody what's going on, back in the 90s or in the 80s, or they wouldn't believe you, right? That's if you come from the future, nobody's going to believe you because it sounds so ridiculous. And so, the question still in 2021 is, how does this not end badly? But at the same time, could it go on for another decade, which we thought going on for one decade was insane. And now it's like, well, if it went on for one, how does it not go on for two?
And that's why we like using models, because I don't know if we're in December of 96 or if we're in February of 2000. Because if we're in February of 2000, we're 30 days away from the peak and we need to get out. But if we're in December of 96, we got a lot of runway that's going to be really nice for the next few years. And I don't know, anybody that says they do know doesn't. They're lying to you. And so I go and say, we trade the market we have, not the one we want, not the one we think we ought to have, because there's been plenty of people that were right way too soon, and it cost them a lot of money.
And if you look back historically, just purely from an economic standpoint, if any country that's ever just printed, it just ends badly. So is it different this time that we're actually going to manage our way out of this, that it's just a different time and a different place, and we are the biggest economic superpower, and we'll make it out alive, and it's going to be different? Or it's like it's really not any different and it will just end badly?
Well, I can make the case that it's a little bit different, and in this manner, not that printing money is good, but currency is something that is all relative to other currencies. You can't say, what's the price of $1? Well, it's relative to the yen, the euro, the pound, the yuan. And so if everybody else is printing, and right now nearly everybody is, then what you see is we stay sort of on par. A perfect example is if you look at the Swiss currency, it's appreciated dramatically in the last decade, the last 12, 13 years against nearly every other major currency. Why? Because they haven't been printing money. But so it may be different. The printing of money is not good, but if everybody else is printing, then on a relative basis, you can stay for a longer period of time. But I'm not ruling out that it could end very badly. The question is when.
So it's either musical chairs or hot potato.
Yeah. Yep. But if everybody keeps printing money, it's currency is on a relative basis. So if you go back and you say, well, what about the Weimar Republic in Germany in the 1920s? Well, they were printing tons of Deutschmarks and everybody else was not. The pound sterling was the reserve currency back then. And so it devaluated dramatically. You look at Zimbabwe in the 1990s and early 2000s, they were printing money like mad, and they started lopping off zeros, 3 zeros at a time off their currency because it was devaluing. But that was because they were printing so much and nobody else hardly was. But when everybody is printing, it's sort of, we haven't seen that before. So I think we just have to wait and see and be ready to make moves, when the markets start moving. But the sales are full and we're going forward right now. So it's not like pull them down and throw out the anchor. In hindsight, that may be the thing to do, but we don't know that. And we don't have a crystal ball that says, oh, now we're at the very top, let's get out. Because you could have said that, 6 months ago or a year ago. And we've seen that in the last decade, higher and higher and higher. And if you bail out just because you think it's high, it can always go higher. So it's wait and watch.
I think that's a good summary.
So one more, maybe for Linda, somebody's asking, is it still too late? Is it too late to refinance? We're talking about interest rates going up. I know we had this discussion with clients. Any thoughts on if you haven't refinanced by now? Is it?
No, it's definitely not too late to refinance the house that you're in. If the question is, should I buy a house right now or should I invest in rental property right now? Different answer. But if you're in your home and you're planning on staying in your home for a while, and your interest rate is, I would say, at least 1% different from what you could get out there right now, this is an excellent time to refinance. Just be prepared to give away every document about your life possible. So no liar loans this time. You have to support every financial choice that you've made for a while.
Okay. Well, I think the questions have kind of petered out a little bit, so maybe we'll call this the end. So I want to thank everybody for your attendance. I believe, Jay, correct me if I'm wrong, there's a short survey after the webcast ends. So if you could take a few minutes just to help improve what we're doing, answer a few questions, we really appreciate your feedback. Like I said, if you want copies of the slide, or let us know, or if you want to watch this again over and over, it'll be posted on our website, forwarded on to friends and family. Like we said, as we get close to the end of the year, we want to continue to have discussions with you, whether it's tax planning or otherwise. And to David's point, as the proposed tax legislation and spending gets confirmed, then we'll really be able to understand how we need to make changes to your tax and estate plans and make sure everything's still functional. So we'll be in touch as those go. So at this time, we're planning on having our next webcast, final one for the year, sometime in November before the holidays. So we look forward to talking with all of you soon. Thank you very much. Have a good weekend.
Thank you.